The Federal Reserve just out with its policy statement Wednesday afternoon, foreseeing a big, really hiking up its forecast for economic growth. Well, let's get a read from Liz Miller. She's president of Summit Place Financial Advisors. Welcome back and good afternoon, Liz.
Thank you.
The Fed ramped up its economic growth forecast, now seeing growth this year to 6.5% versus its earlier forecast of 4.5%. Unemployment putting it down to 4.5%, the rate from 5% earlier. Was this growth forecast even more stronger than what you'd expected? Any surprises?
A little bit of a surprise there. We certainly expected some adjustments to those expectations. I think the GDP growth wasn't as much as a surprise as I didn't think they would be adjusting that unemployment. You look at their statement, and Powell really has been consistent, even as the markets struggle to understand that. He says the Fed is committed to maximum employment and sustained inflation over 2%. I think with this statement and even in some recent public appearances, he's tried to address the issues the bond market is struggling with. If we're going to have a great, strong economy, then how do we expect to keep rates low, and how does inflation fit into that? And I think the message is they are now expecting 2.4% inflation this year, but then for it to moderate. And I think that's the important forecast that starts bringing some shape to how the bond market interprets the current Fed policy.
In other words, that the inflation is transitory.
Absolutely. That we will see increasing inflation this year, but they don't see structural reasons for it to be maintained. And as we know, over the past, 10 years even, it's really been a struggle to get inflation to stay even at or above 2% for any sustained period of time.
And Liz, according to that statement, 4 officials now see a rate hike possibly in 2022, whereas before there was 0 as of December. What do you read into that in terms of what it means for the pace of increase in Treasury yields and interest rates?
Well, the majority of the Fed is still saying very dovish and saying, 23, end of 23, really even 24. I think that this is the first split that we've seen this way to bring it forward a little bit. I think we're going to really have to watch that going forward in the statements, see if these members stay with that forecast in their dot plot before we interpret too much from it.
Do you think that the Fed has managed to convince investors that this easy monetary measures won't overheat a rebounding economy that's just getting stimulus right now?
No, I don't think the Fed has convinced investors of that. I think that is the huge open question. And it's an interesting question when you think about we have not had runaway inflation for 30 years. And yet so many investors still have that fear and have that outlook. I think what the Fed is trying to tell us today, and we even heard this from Janet Yellen back when she was the Fed chair, struggling with declining inflation. The Fed would much rather have increasing inflation. They feel they have the tools to manage that. So they're not as afraid of rising inflation as investors seem to be. They are much more afraid of disinflation and actual deflation, both situations that the Fed has almost no tools to really fight.
Well put, Liz. Then how do you read the way investors are taking it right now? We're seeing the Dow rise further. The NASDAQ and S&P was earlier in the minus column before the statement came out. Now they're in the plus side.
Yeah, we saw a very positive, quick response in the markets from this statement. I think the response is to the higher growth forecast, though it shouldn't be such a surprise. We've certainly been anticipating that. The market is fully anticipating a recovery where the Fed is a little more cautious because they're really focusing on unemployment. Even as we see the strong turnaround in the market after this statement, we are seeing it all on the cyclical side. We're seeing it in the areas that really benefit from the improvement. We continue to see those techs consolidating sideways, pulling back a little bit. When we look across the major tech companies, you really see them having a tremendous run off the lows last year, but kind of going sideways from September till now, giving back whatever they gained early this year back to those December levels. I'm not worried by any of those, but we do see them consolidating, as we say in the business, is the best word for it. And we kind of expected that outsized gain to kind of go sideways for a while the other areas that have been ignored caught up in the markets.
Okay, thank you, Liz. Appreciate it.
Thanks.
Our thanks to Liz Miller and her analysis. She's with Summit Place Financial Advisors. I'm Fred Katayama in New York. This is Reuters.